And if they are eligible to claim that exclusion, then they can exclude around $250,000 of the net capital gain on their US tax return.
Hi, Aya. Thanks for joining me on video call today.
Hello, Clark. Thanks for having me.
Aya, I know you help a lot of people who have sold property deal with the US tax implications. And I wanted to ask you a few questions today about quite a particular scenario that quite a few people are facing at the moment. If they sell their home, do they have to pay capital gains tax to the IRS?
Well, that really depends. It depends on many factors. One of them is to start with the location of the principal residence. Where is it located? In some countries, if they are a resident of another country other than the US, then these countries sometimes do not impose capital gain tax on the sale of the principal residence, which means that they do not have foreign tax credit to claim on the US tax return.
Countries like the UK, Australia, where they don't charge capital gains when you sell your principal home.
Yes. In other cases, usually there is an exclusion on the sale of your principal residence for certain taxpayers. And if they are eligible to claim that exclusion, then they can exclude around $250,000 of the net capital gain on their US tax return. It is $500,000 when they're married filing jointly.
So let me check a few things. So I'm based in the UK. So if I sell my home, obviously the UK government won't charge me any capital gains on that, which is terrific in a sense. But then the IRS might. And what you're saying is the first $250,000 worth of profit that I make won't be taxed as a capital gain. But if I make more money than that, which would be quite easy actually in the UK or Australia for that matter, then I could possibly be taxed on any profits that I make above 250,000 US dollars.
Yes, that's correct. So anything above the exclusion amount will be taxed on your US tax return.
So if we're talking about profits then, how do we work out what the profit on the property is? What's the calculation?
The first thing, it depends on the holding period of the property. Well, let me step back. So actually, if we're talking about principal place of residence, then usually, if you have the property and lived in the property for 2 out of the 5 years, out of the last 5 years up to the date of the sale, you will be allowed to claim the exclusion. Any amount on top of that will be taxed. The tax will depend whether it's held for a short term or a long term.
Okay.
So the period of holding the property really determines. In most cases, if this is our example, then it will be definitely a long-term gain because you've had it for 5 years.
So when we're working out the profit, do I just basically look at what did I sell the property for and then deduct what I bought it for? Let's just say I sold the property in Australia for $1 million and I bought it for $500,000. So I've got a $500,000 gain. Can I deduct anything else from the profit before it's taxed? Like if I'm paying estate agents to sell it and I'm paying solicitors, conveyancing fees, what if I've done like renovations and replaced the roof and added a garage on and stuff like that, and all that would have cost me money? What do I get to deduct before the IRS hits me up?
So what we usually consider is what gets added to the cost basis and what is considered selling expenses. So selling expenses could be, for example, advertising expenses, attorney fees, commissions, notary fees, settlement fees.
So that would cover most selling things for most people, I would imagine.
Yes. One thing to consider, which is really important, is the foreign currency exchange rates. If you made a profit or a loss, let's say, for example, in UK or Australia, it does not mean it is exactly the same outcome on the US tax return. We have to consider the foreign currency exchange rates.
So you've got to look at the exchange rate on the day you bought it and the day you sold it to see if you've made a gain just on the foreign exchange as well as the buying and selling price.
Yes.
So I think that's something that people forget quite a lot, right?
Yep. We see this a lot.
What if you made significant improvements to the home while you owned it? What can I deduct from the profit?
Yeah, usually that gets added to the cost basis. So anything that improves the property itself, any cost that gets added to improve the property value or the property life value gets added to the cost basis. So your cost basis is going to be higher.
So that's also going to reduce the capital gain
Net cap, yes.
significantly. Okay. Anything I've really done to the property while I owned it, I can, what the expenses that I've gone to, I can deduct from the profit, which is great. Do I need documentation and receipts and things like that to be able to show that I've spent money on the property?
We always advise Clark to keep the receipts and to keep any bills you spend, just in case the IRS ever question, you have a proof.
Yeah. So in a nutshell then, and I've got some of the questions, but we're going to look at the selling price of the property. We'll deduct any of the selling costs, what you paid, solicitors, lawyers, etc. And then anything you've spent on the property while you owned it, we're going to take that off as well. And then ultimately, we will deduct what you paid for it. And then you're left with a chunk of profit in the middle, hopefully. And then the IRS will give you the first 250,000 US dollars capital gains tax free. And then you're going to pay capital gains tax on the rest.
Yes.
Cool. Aya, you mentioned earlier on in the video, you were talking about how you get this $250,000 allowance. I got a couple of questions for you on this. So if I was married to a non-US person and we owned the house together, and if we go back to that example where I bought it for $500,000 and sold it for $1 million, do I pay capital gains on just the half of the property that I own or on 100% of the property?
So usually you would pay only on your share as a US person. If your spouse is not a US person, then her share will not be taxed on the US tax return. Unless, I see this a lot where certain taxpayers, they elect to treat their spouse as a US person to get more deductions. It may change the situation at the end of the day to claim more deductions, lower tax rates, etc.
So is what you're saying is that some people decide to bring a non-American spouse onto the US tax return because then you'd get $250,000 capital gains threshold each. And does that generally work out then as a benefit?
Honestly, it is an option to consider. It works in some scenarios, while in other scenarios it does not work. It really depends on many other factors, because once the spouse does the election, then the spouse's worldwide income is considered taxable on the US tax return. It depends really. There's no easy answer for it. It's best to check with a tax professional.
Yeah. So quick scenario. If I bought my own place, I've been living there for more than 5 years, and I've made more than $250,000 after I've put all my deductions in. If I just nip out and get married really quickly and throw my new spouse on my US tax return, do we get $250,000 each? So I now have a $500,000 exclusion on the capital gain?
It may be possible, Clark, but there are other factors to consider, such as the ownership of the property and the use of the property. There are as well other criteria.
So like, is one of them the fact that kind of silly scenario I made up wouldn't work because we would have had to have been married to and living in the house together for at least 2 years?
Yes,
and
because of the use.
And I guess there's a whole bunch of other things as well. A lot of other boxes to tick. But potentially, though, if you tick all the boxes, it may work out.
In some cases, yes. Depends.
Oh, yeah. So let's say, I've made this $500,000. I've deducted all my selling costs, all my property improvement costs, and I've still got $400,000 of profit on the table. So you said that the IRS won't charge me anything on the first 250, but that still leaves another $150,000 profit on the table. How much is the IRS going to slam me on that?
As I mentioned earlier, it depends usually. With capital gains, it really depends if it's a short term or a long term. In your current specific scenario, it is a long term that may be taxed at the maximum of 20%.
Okay, so I'm going to be on the hook for about $30,000 in that scenario.
Yes.
We talked about if we're selling our principal place of residence, so our home where we live, But what if we're selling like a commercial unit that we've been renting out, or a rental flat, we've been renting that out? Is it the same kind of deal on the US tax return?
Not really. That's quite different.
That sounds like maybe a topic for another video then, if the details are all different.
Yes, definitely.
I know you help people a lot with property in this kind of scenario from lots of countries around the world when dealing with the US. If people would like to get your help, how can they do that?
They can go to our website, that's expatusTax.com. They can go to the teams, they will find me there, and they can send me a request, and I'm happy to give them a call.
That's brilliant. Thank you.